Victor, there's a $3 trillion private credit ecosystem that's always lived kind of in the background and in the shadows. That's recently had a really bright light shown upon it, as we've seen with software repricing and a bunch of loans that are under consideration. Gates have been capped. People can't exit these funds. What's going on?
Yeah, thanks for the intro, Hunter. I'm excited to dive into this topic today and give our listeners some insight into what really has, I would say, was emerging, but is an emerging and really an established at this point asset class, and that is private credit. And so just to kind of take a step back, kind of define what private credit is before we dive into the nuances. I'm sure some of our listeners have seen some of the commentary from, CNBC or Bloomberg or in the news about the, what's going on in private credit right now, some disturbances. We're going to kind of, create a BS filter here and kind of distinguish, fact from fiction and try to articulate what's going on in the private credit space, what's important to look at versus what we think is a little bit overblown. And so kind of starting with what is private credit, it is exactly what it sounds like. It's just loans made by private companies to private companies for the most part. And so that is, you have these fund managers, their investment vehicles, where these companies are lending on a more flexible basis to companies that need financing. And so a traditional loan is made through a bank, whether that's in the private markets, you have a broadly syndicated loan package and it gets sold to investors in the form of bonds. Well, in the private credit space, these are asset managers. Think of your Apollos, Blackstones, Ares of the world, Blue Owls, who are bringing in private capital from investors, maybe some of you listening on this video right now, into a fund vehicle and then lending it out to companies that they believe will pay them back. And so private credit, essentially, what really was the promise when this became, a new asset class or really became a developing asset class was that these are floating rate loans. So they're going to move up and down with interest rates and they're not subject to interest rate movements as far as their pricing so much. They're going to yield more because they're flexible, they're easier financing. So it provides some leniency for the person taking on the loan. And they're going to generate, better returns than a traditional, corporate credit bond. And so these are typically in kind of the high single digit % range as far as the interest on the loan. And so it became a very attractive asset class because all of a sudden investors didn't have to worry about their duration risk when it came to what the yield was at initiation. They knew that was going to move up and down. And especially in 2022, when we had this rising interest rate environment, that became very attractive because you didn't have to worry about how high rates were going to go. As they went higher, your loans were going to step up with it. And there's a lot of nuances in there and differences between the fund managers, but that kind of provides a baseline level of what private credit is.
Yeah, and I think that's a great thing to call out is that these really started becoming way more popular going private credit route after the great financial crisis, where there's a lot more bank regulation and banks, largely started stepping away from some of these smaller business, middle market business loans. And, really culminated in kind of 2022, rates were going up. People wanted a fixed income alternative to bonds that are fixed rate, and getting crushed when they were supposed to be the safe part of the portfolio. Well, here's a floating rate alternative, a little bit higher yield, but still, from the outside at least, looking very safe as a good non-equity portion of your portfolio. So that kind of kicking all of this off. And then now with any new asset class, especially one that grows so fast, so quickly, we're starting to see either cracks or just concerns one way or another about what, kind of that space.
Yeah, and I will say that another feature to private credit that was attractive for the investor is that typically these are senior secured loans. So you're talking about top of the capital stack, where if a company is under pressure, these credit holders are the ones who have to get paid back first before anyone else. Of course, equity holders or stockholders in the public markets, they're the last ones to get paid at the end of the day. Whereas these credit issuers would be the first to get paid back in the case of company stress. And they're also the promise of these, or the premise of these private credit funds and private credit loans, is that they weren't very volatile in portfolios because you're doing what's called marking, just meaning repricing these loans. So when we talk about marks, we're just essentially talking about repricing. They're repricing these loans roughly once a month or once a quarter instead of every single day. So for an investor looking at them in a portfolio, they weren't seeing huge swings when you compare that to publicly traded bonds that do move up and down with interest rate movements on a daily basis. So the promise was it's pretty secure capital, you're getting a good rate of return, and you're experiencing low volatility, which sounds kind of like a golden situation. And it kind of worked that way for a while, but now we're seeing some signs of stress, as you mentioned. And so it's really this first test of this asset class as far as, hey, maybe we need to look underneath the hood and distinguish, which of these funds or which private credit investments are quality versus which aren't. So Hunter, if you could kind of get us into, or at least kind of lead us with, what people are seeing in the market, like what's causing the scare, and then we'll kind of set the stage from there and then talk about, what's actually happening under the surface.
Yeah, well, really what brought it to the broad public attention and really captured all the headlines were when funds were getting gated. And so what gated means is that most of these bill themselves as semi-liquid or partially liquid, as opposed to true, kind of your traditional private credit or private equity deals, especially where you have lockup periods, you're in it for 5 to 8 years, really no option to get out sooner. These offer, usually kind of industry standard is quarterly redemptions of up to 5% of the fund NAV or asset value. And so when you have a bunch of scared investors who get spooked and they kind of rush to the exits, they close down the gates and say, you can be prorated, but we're only letting 5% of the NAV, out this quarter, which is how they're designed to be, because these are illiquid investments. And so in order to protect the existing shareholders, the remaining shareholders, they want to make sure they don't have to go out into the market and fire sale these assets, these loans. And so, in order to protect the existing investors, they gate it at a certain level, but that looks pretty bad to people who maybe entered this under the idea that they could get their money back whenever, except for, huge periods of stress, but, that won't happen. You can just take your money whenever you want it. I think there's a little bit of, misunderstanding, misbranding going on with, like I mentioned earlier, a very new and fast growing piece of the market. And anytime you have that, you have investors who maybe shouldn't be there in the first place. You have, a lack of understanding, and, that kind of turns into headlines of, this fund got gated. You had 40% redemptions this quarter, and they only met 5% of them.
Right. And I think that's a perfect way to set the stage for how we got to this situation. And now I want to start differentiating of what is actually happening under the surface, things that we are paying attention to that can be of some concern versus what is not. And so first, I think talking about what we are watching that is important to really pay attention to is the fact that because this asset class became so attractive, it was bringing in massive amounts of capital. And whenever these fund managers were attracting this much investment flow, they had to allocate that. So all of a sudden, you have a lot of dollars competing for a relatively finite pool of loans, especially when you're talking about the massive funds that are having to allocate billions of dollars to debt deals. Well, all of a sudden, you're starting to look more like a traditional bank syndicated loan because you're having to, give to borrowers who can absorb $1 billion loan or $100 million loan. And that started becoming very difficult. So all of a sudden, when you had, very well structured, very secure loan packages on the onset of private credit, they started having to get lighter with their covenants, which meant it became more friendly to the borrower, not to the issuer of this credit. And it made it less secure just as a total investment package. So all of a sudden, the underwriting of these loans, while they were still doing their best to underwrite quality loans, it was because it was so competitive in the space to allocate this capital, it started getting difficult and they had to get easier as far as what they were letting the borrowers get away with. So you had some slippage as far as like the safety and quality of the loans in the book. Now, also, I mean, you mentioned the illiquidity aspect of this. You have to pay attention to how companies are marking their loans. Is it a third party that's valuating these loans, or is it the fund manager's discretion to kind of put a value on the NAV or the net asset value of these loans? When it's up to the manager's discretion, obviously they can kind of decide to change the marks on their book to what's going to be, at the end of the day, more favorable to the investor, and that can only last so long. But I think something that's really important to pay attention to is the use of leverage in these funds. So first, you have to talk about the borrower leverage. So that's how much is the end company that's taking on this private credit loan, how much are they borrowing compared to how much are their assets worth? Now, if they borrow too much money and it becomes their debt to, say, debt to equity, or their debt to EBITDA, so essentially their debt to how much money they're generating, once that ratio gets too high, it starts putting a lot of stress on the end company, on the end borrower, and it starts making that credit book less valuable. There's also fund level leverage whenever it comes to these investments, and it's something important to pay attention to, because in order to increase the returns on the overall private credit fund, a lot of these fund managers are taking on their own debt because they can get very cheap financing. So if I'm lending money out to you at 9%, but I can get my own cost of capital, I can borrow at 5%, all of a sudden there's a spread there. So I can borrow to lend to you, and that's increasing the return for my end investor. So that's very common in most of these private credit funds, which for the most part is okay if I truly believe at the end of the day that you're going to pay me back. But if it becomes too much leverage, then you're just increasing the likelihood of stress in that situation, which can be concerning. And then finally, you have to talk about your end investor leverage. If I'm investing, or a institution or a pension is investing in a private credit fund, how much are they borrowing to put into a vehicle where the fund manager is borrowing to be concerned about the end borrower? So this cascading leverage effect is something that really has to be paid attention to, and especially when you're talking to fund managers or analyzing a fund. How much leverage do the end borrowers, how much are they taking, and then how much leverage is the fund using in order to juice up the returns in that private credit fund?
Yeah, and something I want to call out on the borrower level leverage is that in a perfect world, in a very status quo world, a lot of this stuff will generally balance out and not be too much of a concern. It can be a concern, absolutely, but something that really just made it worse than it would be under normal circumstances is the quick raising of rates that we saw in 2022, right. The rate hiking cycle. So these companies are coming in borrowing maybe at 5%, thinking, oh yeah, I can absolutely pay my 5% loan every month. That's not an issue. I'm golden. A year goes by and it's now a 9% loan. Well, all of a sudden that changes their economics dramatically. That puts additional pressure on their business, like you were talking about with the debt to EBITDA ratios getting, out of whack of what they initially were thinking they're kind of signing up for. And so it's that, things like that are changing in the background too, that add, additional leverage to this, even if the borrower thought they were being very responsible in the first place. So, lots of layers to how these things can work and move. And obviously that's only one example of this whole stack of things, but important to, keep an eye on too.
Yeah, no, absolutely. And I think, so we kind of talked about the leverage aspect. Mm-hmm. We talked about the allocation aspect, all of these dollars flowing into this asset class. But the spark that I feel like really ignited this latest concern around private credit is the AI and software dilemma. Mm-hmm. And so a truth about the private credit space, and especially early on, but a continuing aspect of it, is a lot of these loans were made to what these fund managers viewed as non-cyclical, non-risky sectors, and one of those being software. And so a huge portion of private credit loans went to software companies because they had solid revenue, they had good margins, they were integral into company systems, And they were looking at this like, hey, everyone's going to need software. They're going to have to keep paying that annual fee to maintain their software systems. And this is just going to grow as far as these portfolio companies are concerned. So why wouldn't I lend to these software companies? And then we hit the AI wall when everyone now is starting to worry more about AI and displacing software companies. So that's what's really got this ball turning as far as concerns about the private credit market.
Yeah, because if you think about software, it really is kind of a darling for a credit fund manager. It's, like you said, it's growing annually recurring revenue that's fairly integral to people's businesses. Most of the time, people aren't really paying attention to, oh, maybe I'll get rid of my Adobe software and change it to something else. That's usually not too much of an issue because it's just such a background core part of people's businesses, until there's the worry that AI eats software, and that, kind of sparking what I was talking about earlier of people rushing to the gates because so many of these loans were made to companies that should be the, perfect, easy, no worries kind of customer.
Right. And I think we talked about this on our 2026 Outlook podcast and the concerns around software companies and AI displacement. And we think that if you're thinking about the private credit industry and where you have to be concerned and where you don't, it's less so that these companies are going to be completely displaced by AI. And so it's not necessarily the fact that, AI is not going to kill all software companies, but it is important to pay attention to in the grand scheme of as far as how you're looking at a loan portfolio in a private credit fund. I think the more important question is how many of these software companies are really exposed to AI displacement, not just, hey, what percentage of AI loans software loans are in the portfolio. Mm-hmm. It's more about, hey, let's look a little bit further under the surface and see, what is the true risk to AI that these companies have. Because at least so far, we've seen, some cracks here or there. But if we look at public company earnings, software companies have remained relatively strong. Now, their stock prices haven't necessarily. But what we're seeing, especially already in this quarterly earnings cycle, is that software companies continue to perform. And it doesn't look yet like that's the major concern when it comes to private credit.
Yeah, I mean, there are concerns that they'll have fee compression, but I think for a lot of these, they will continue to be that kind of core piece of the business that maybe you can have AI interact with, but not necessarily replace. Like you said, we've talked about this before, but, kind of that idea that AI not eating software, but, just maybe reducing its profitability. But like you said, we haven't really seen that as of yet. But with the stock price going down so quickly and dramatically, like we've seen in so many of these software companies, that kind of goes back to what you're talking about as far as, debt to equity ratios. If your market cap or your enterprise value is decreasing all of a sudden really dramatically, then it can at least look on the surface like your debt loads are unsustainable. So, that is a real, change that is happening because of the perception that something might change in the future. So it's kind of funny that you have, a chain of things, maybe 3 iterations down. The perception that AI will overtake software is creating some tangible actually results and differences today.
Absolutely. And I think whenever we're looking and whenever we're analyzing these portfolios, I mentioned look at which software companies are more subject to AI displacement. That's, of course, very important. And I think if you're interviewing a fund manager as far as what their loan exposure looks like, ask that question. First, how much software exposure do you have? Second, hey, have you analyzed the AI displacement risk factor associated with the software holdings in the portfolio? How do you feel about that? But then I think we should also talk about how these loans are kind of underwritten. And are you looking at the core metrics in the right way? Something that I want to bring up is payment in kind, and the payment in kind levels commonly referred to as PIK, P-I-K, payment in kind, in these portfolios. If that is trending up, that is of some concern. So what payment in kind is essentially instead of paying the interest on the loan with cash, you're just tacking on the interest onto the principal of the loan. So the loan size is getting bigger. It's being paid in the fact that the loan is, continues to increase, but it's not getting paid out as cash. So if all of a sudden a fund manager is reporting that the PIK portion of their loan book is increasing quite substantially, that's something to pay attention to and to be wary of, because that's when companies start getting in trouble, is their loan balances are increasing and they're not actually really paying that interest back.
Yeah, I think it's kind of funny to hear how people describe it, but people generally describe it as good pick and bad pick.
Right.
Of, in an efficient world, there is good payment in kind that goes on, because it's the same reason companies are taking these loans in the first place, just additional operational flexibility. But at the same time, to your point, if you see those changing dramatically and at a portfolio level, then it really shoots off some warning bells, because that's not something you want to be seeing happen.
Right. So I think when paying attention to these fund managers, like I mentioned, focus on PIK, focus on the software exposure, especially the AI factor, and then also how the loans are being underwritten. Make sure that it's on an EBITDA level, and not just on looking at future growth, because all of a sudden the future growth aspect of this formula has changed with the advent of AI. And so that kind of gets us into, which fund managers are most exposed and which aren't. And I don't really want to get after naming individual fund managers at this point. We want to provide our viewers and our listeners with a framework of how to evaluate these loans and these loan books. Now, commonly, if you're allocating to private credit, you're working with a financial advisor, because you're not going to be able to allocate to private markets by yourself. We see a lot of value in private markets, even still in the private credit space at this point. But, focusing on what makes a manager valuable versus which ones don't. And I think, who's going to be most exposed right now, it's those tech forward lenders. There are some lenders in the space who really kind of focused on the software and tech aspect. And it's unfortunate for them that they got caught up in this AI wave that is having more displacement in their book. And so just making sure that that's a right-sized piece of their portfolio is important. I think those that are moderately exposed are kind of your broad-based BDCs, ones that have diversified exposure, because you're going to have a more modest part of the loan book that's going to be exposed and potentially displaced by AI. And then whenever you get to the most conservative, I think the lenders that are the least exposed, you're looking more at those middle market lenders. And I think whenever you and I think about allocating in private credit, we prefer that middle market or lower middle market space, because as we mentioned at the top of the episode, you don't have so many dollars flying in that need to be allocated to these major players. That's when those loan covenants get a little bit soft and the loan terms get a little weak as far as the allocators go. In the middle market space, there's more leeway for that. The companies are smaller. They're not allocating as many dollars. And some of that has to do with fund size. Some of it has to do with a manager and what their capabilities are lending to a space where there isn't such broad kind of syndication amongst the major managers. So that's where, we kind of prefer to look as far as private credit right now. But of course, it's always developing and always worth analyzing as far as where the shifting dynamics are, in the space.
Yeah, I think that's a really good point about the middle market and lower, middle market kind of lending in the first place. Because to your point earlier, if you have $1 billion to allocate, you're not looking at a $25 million loan. It's not worth your time. You don't have the time to look at that. And so going down to those smaller players who can keep those covenants intact, who can properly vet, a deal of that size. And finally, the lack of competition in that lower space, or at least the lack of dollar competition, because, for a $250, $300, $500 million loan deal, you have a bunch of groups that are all allocating billions of dollars. So that can, get really competitive really quickly. And then finally, it's pretty, it's broadly reported what portion of a private credit fund is, in arrears and delinquency, in actual default. So keeping an eye on those levels and just being cognizant of what that looks like. I mean, that they report that out. So you can see not, from that's kind of a reactive example or a, trailing time period example, things have to already be going bad for you to see that. But one more thing to check and one more thing to pay attention to, because, one or two loans in delinquency is not the end of the world, but that is definitely a track that you need to pay attention to if that's getting worse, if it's getting better. It's one more thing to look at.
You make an excellent point there, because in the credit world, there's always going to be loans that don't perform. You're talking about thousands of loans, or at least hundreds of loans typically in a loan book. And it's always going to be the case that something doesn't work out. Some company, there's some unforeseen circumstance, the company runs into an issue, and all of a sudden the loan, maybe they're not going to be able to pay their interest for a few quarters, or something's going to happen where there's an issue with that loan. That's going to happen across the board, and that's why the risk management piece is so critical to these private credit funds, because it happens in the public markets as well. Not all bonds pay back 100%. Public companies run into issues too, and so this is nothing new to the space. And I think that's why it's important to look for teams that have had to work out non-performing loans. Ideally, these companies are able to offload the credit before they have to take over the company necessarily, but it's worth asking managers that if they've encountered situations like this, if they've had to take over a company or their assets, how do they work that out? Do they have a team that's capable of doing that? And then I also really want to make the point that we've been talking about private credit. We've been mostly referring to direct lending, which is just these asset managers making a direct loan to these companies. There are different types of private credit. There's a lot of asset category that's getting popular in the private credit space is collateralized lending. So if you have a specific asset that you're borrowing against, that's something that could be a little bit safer, because you're talking about hard assets, and if they maintain their value, then it's more likely that the person lending the money or the company lending the money is able to get their capital back because they have a hard asset that is backing that loan. So if you're looking for a little bit less risky areas of the credit space, sometimes in the collateralized lending category, those funds can be a little bit more conservative. I think it's worth noting.
Oh, absolutely, because there's a whole umbrella of specialty finance loans that can be really compelling. They are a lot smaller and not frequent enough, at least besides the asset base, because there's plenty of assets in the world on which to base credit lines.
Right.
But then you get into more specialty stuff that isn't so big. So again, the right manager, the right size manager to go after those. But you're talking about like royalties, established contracts, all sorts of bridge financing for companies where the interest rate and the default risk are kind of mismatched, but they only need a loan for a month while they wait for Walmart to pay them. Great. There are all sorts of these things that you can go down the rabbit hole on, and that are very interesting places to be. But as far as big, broad ones to get exposure to, asset base is absolutely worth considering and talking about.
Yeah, I think so too. Now, I feel like we can kind of wrap things up, at least as far as what our listeners or investors should be thinking of, especially whenever they're talking to their financial advisors. If you're working with someone who's allocating you to private credit, be asking some of these questions. Make sure that they understand the underlying fund managers that they're placing your capital into. This is extremely important, and we do a lot of work trying to make sure we're underwriting the underwriters, if you will, making sure the fund managers that are taking care of our clients' capital are in a good place, are secure, are safe. And bring it back to the top, I think there are some concerns in the private credit space. I think they're mostly overblown, and the media has kind of blown this out of proportion. We don't think AI is completely displacing software, but manager selection is very important. So you have to separate those two things and be prudent if you're allocating additional capital to these things. We don't think, for the most part, it's worth running for the gates. These are supposed to be illiquid. They're supposed to play out over time. The beautiful thing about private credit is it's a somewhat self-liquidating asset. It's paying distributions. There's a term on these loans. They're not forever assets. So it does create some nice natural liquidity to the system. And I think the fact that these funds have these gates is going to kind of save the industry from something like a bank run. I mean, if we look at the regional bank crisis of 2023, if if consumers or investors weren't able to just go grab their capital, there may have not been an issue at the end of the day. But that was the case with it. I think private credit might be saved by this gating system. We'll see in a couple of quarters. I think it's going to be really interesting as far as how we evaluate private credit funds and what the redemptions look like a quarter to 3 quarters from now. And we'll kind of see how that plays out.
Yeah, I absolutely think that's a great thing to end on, is talking about the gates. They're there for a reason. They're there to protect the existing investors, and especially within private credit, like you mentioned, is a self-liquidating asset, so they can manage that 5% gate very well for an extended period of time. Generally, a good manager can, without worrying about selling off assets at below market prices or making any changes to the fund that would be detrimental to existing investors. So great example there with the banks. I think that's if you see a fund get gated, that in and of itself is not a bad thing. There could be an underlying reason that's driving these people, but from a lot of the ones we've seen, it's just been broad investor perception more than anything else.
And I think if there's one takeaway from this entire episode and from a lot of our education that we provide to our clients, is know what you own, know why you own it, and what your options are as far as the future in this investment. And if you're working with a financial advisor, talk to them about these things. Hopefully they're educating you about these things. That's what we like to do at Beck Capital. And I'm sure we'll have some future episodes on this going forward. And like I said, it's going to be interesting to see how the space develops.
Yeah, absolutely. Thanks, Victor.